cut out the whole first 10 or 11 minutes so you don't have to suffer through that. All right, so this is an introduction to volume profile, and this is what we can expect from today's class. You're going to learn about what volume profile is, the tools that I recommend that we use, and of course there are many other tools around that support volume profile, but not so many. And like I said earlier, one of the things I did with earlier classes was that I talked a lot about the origins of a volume profile, why, its efficacy and so forth. And that kind of gives you the background as to why most trading platforms don't include volume profile. But I'll just say it in short. The reason why volume profile is not included as a standard thing, and when you can get it, it's always a paid for option, is that it's considered a professional feature. And well, from that, you can surmise that professionals are the ones that tend to use it, not retail traders. And there's a reason for that. And that's essentially because most people have been fed this kind of narrative that steers them away from trading with volume. And the reason for that, and this may sound conspiratorial, but I'm telling you, I know this from firsthand experience in working with brokers. And the reason is that brokers don't want you to succeed. They want you to, and that may sound counterintuitive, but what they really want, and they don't care if you succeed or make a lot of money, what they really care about is that you create transactions. And they want you to use what everybody else is using. And I'm sure you know that 90% of most people that are trading are losing. And they're all following essentially the retail narrative of price action and day trading, that sort of thing. And very rarely, or if ever, does volume come into the equation. If you were to go and look at professionals, it's exactly the opposite. Exactly the opposite. They're mostly using volume and order flow and hardly ever using price action. They may use price action and charts and stuff like that to kind of model their ideas, but that's it. They're not actually using it to make trading decisions. So that's a fundamental difference. And you would think that, man, if the pros aren't doing, the pros are doing it that way, why aren't we doing it that way? And it's not because it's harder. It's because you're kind of steered towards one direction. So, everybody have their coffee? All right, so that is the reason why you don't see a lot of volume-oriented tools. If you were to, yeah, I got to turn this off here. Turn that phone off. I'm going to turn my messages off. And then I have a little presentation. So what I wanted to say is that, since the beginning of markets in the civilized world, I guess that brings you all the way back to like the mid 1800s when the original stock markets came online, or not online, but they came to be. All the way up until really the early 1980s, there was no access to real-time information from the market in the form of something that people could use on a computer so that they could generate real-time charts. Didn't exist. And it wasn't until people started becoming networked, and then when the internet came out, that people started to have access to online charts and indicators and that sort of thing, and make different decisions. Before that, it was all order flow. And in fact, you can really tell this because even up through the 70s, we used to have ticker tape parades. Now, a ticker tape is, that tape that you see in the old time movies that would spit out orders from the market. And we had ticker tape parades because the majority of Wall Street, and other cities, that's what they used to find out what's happening in the market. And on those ticker tapes, the only thing that actually was there was the asset, the price, and how much was bought or sold. That's it. And they used that information, primarily the volume, to discern supply and demand. And that's the way it was for ages. Now, I know that there are some famous people that have developed systems using price action, like Gann and Elliott, like Elliott waves, and many other people. But they were all working with charts that were created from old data, usually looking at weekly or monthly charts. And so, they all wanted kind of an edge, and they thought they could get an edge by coming up with these really hokey numerology-based or Fibonacci-based methodologies. And not many people really had an advantage with that. There really was no advantage. So volume was really the main thing all the way up through that period. And actually, even after computers came online, it was still the main thing. It's just that now the perception from the retail trader, who never really ever traded prior to that because they never had access to the markets, was that it was all about price action, because that's the only thing that the broker would show. All right, so that's all I'm going to say about that. You're using something this is where professionals are. This is what professionals use. Professionals are primarily looking at supply and demand and volume and order flow. And so I'm going to be showing you two tools. One is called Volume Profile, and another one is embedded in Tensor charts. There's actually a number of tools in there. One of them is called the Footprint. The other is looking at time and sales and the order book. Now, we're not going to really spend a whole lot of time with those tools. I'm just going to show how one might use them to get an idea of how orders are flowing in and out of the market. So most of our time is going to be spent just on Volume Profile using TradingView. So if you don't already have TradingView open, I would recommend that you get that up and running. And so what I'm going to do now is I am going to bring this over here. I'm going to start up the presentation. Just give me a second. Share screen. All right, that's funny because when I share screen, I can't see the chat. Let's see, let me see if I can get the chat up at the same time. All right, can I detach the chat? Pop out, yes, I can. Like I said, this is the first time I've ever used it for a webinar, so I'm a little clumsy with this. All right, so now I have the chat popped out, and let me ask you this. Are you seeing the presentation and it says Volume Profile, big black screen? All right, cool. All right, Volume Profile, Introduction to Trading in the Present. What do I mean by that? That's a critical point here with Volume Profile, that you are trading in the present. With most charts and indicators, you're always trading with something called lagging indicators. In other words, things like the RSI, MACD, stochastic, moving averages, all of them are evaluating a number of bars prior to the actual present to calculate or average or smooth the data to give you the what is today. That's what you see in the present piece of information. So the information you're seeing is actually comprised of things that are in the past. So lagging indicators are what it's essentially saying in using those is that you're trying to discern what's going to happen in the future by what happened in the past. Now, for a lot of people that might make some sense, but wouldn't it make more sense if you had the actual information in the present to then try to gauge what's going to happen in the future, or at least have a better idea of what's going to happen right now? That would make even more sense. When you know something in the past, you might be able to get a sense of where things might go in terms of momentum, that sort of thing. But the reality is that most people can't predict the future with any ultimate degree of certainty more than a few minutes into that future. And I'm talking about in terms of the stock market. In real life, you can't even do that. So it's hard to imagine that anybody can predict the future based on things that are in the past, especially when you get beyond minute charts. If you go to a daily chart or whatever, it's virtually impossible. All right. Now, this is something that I'm not going to spend a lot of time on. However, with your session, your coaching session, this is something that I will go into more detail with. And quite frankly, with the coaching session, we can talk about anything, but I would recommend that we talk about this, which is a winning strategy. All right. And I take all my trading I do in a very systematic way. I take a systematic approach. And if you want to learn this and you want that to be part of your coaching session, then that's completely up to you. All right. So before volume profile came on the scene, there was another technology that was used back from the early 70s and even up to this day, and it's very similar to volume profile. It's called market profile, and it's very similar to volume profile. On the right hand side, you'll see two graphics. The one on the left is called market profile, and the one on the right is volume profile, the one that you may be interested that you have seen, obviously. But the one on the left, it looks a lot like the one on the right, and they're actually both charts of the exact same time in history on a chart. But the way the one on the left is comprised is they actually took the price bars on a bar chart, and say for an entire day, let's say they were 30-minute bars, and then took them and then moved them to the left and let them sort of overlap each other. And you'll see that each sequence of letters actually represents a bar on that chart, and that has been moved over to the left and then sort of overlapped. Now, when you do this, you can start seeing very clearly where most of the time is spent. Now, it's not exactly like the one on the right that is strictly measuring volume at certain price. These are just measuring price, squeezed it, but it's very, very close, but not quite exact. But this was the closest approximation that people could use back then when they first had computers, and subsequently they started moving to volume profile. The advantage of the market profile is that you can actually see how a market starts to unfold. But that was like the first attempt at volume profile, market profile, and still used to today. And there are several patterns that were developed out of that are currently used with volume profile. Now, we'll go into all the specifics of all these bars and what they mean, so don't worry about it. But the thing that you should know that in a chart, there are basically three pieces of information that come through from the exchange. There's price, which they call the advertiser. In other words, that's advertising where the current supply and demand are. There's time, which is the regulator that kind of allows you to see things in a sort of an ordered way. And then volume, which is the validator. Volume is actually the truth. I guess another way to say it is volume is the truth. Price is actually a consequence of volume. So those are the only three pieces of information that are coming. Now, if most people are using charts, most of them are kind of ignoring volume altogether. Sometimes they might have volume at the bottom, but how many of you actually use volume as a primary indicator to try to figure out what's going to happen to price? Most people don't. They might see, oh, volume was really high or volume's really low, and they might have some inkling of it, and that's cool. But again, it's also used in conjunction with time. Now, in volume profile, time is kind of taken out of the equation, and now you're seeing volume at specific price. So it's just another way of taking the same basic information, but looking at it from a different point of view. And that's basically what I'm saying here. So normally we see price with respect to time or volume with respect to time. And but here we're deriving a new way of looking at the data where it's just volume with respect to price, volume profile. Now here's a really important point. Now, one thing that we can say, now we're going to start getting right into, how we actually analyze the markets. And this is a very, very important point. Actually these top three bullets, we'll take these bottom three and kind of ignore those for now. The market works and moves in basically two ways. It's either trending or it's consolidating. And I'll show you that in a second. But when it's trending, that's occurring about 30% of the time. Those are the big, long, straight moves. And then it will pause and then start moving sideways or going up and down, back and forth. That's a consolidation move, and that happens about 70% of the time. And the reason why that's important is that gives you an idea of how markets might behave and also who's actually involved in the market. As a general rule, when markets are trending, those trends, those very, very strong trends, short-term trends, are initiated usually by a different set of actors in the market. And I like to say that there's, well, this is generally what's known, that there are three primary actors in the market. There are the big guys, or the smart money, what we call the long-term traders or long-term time frame traders. They're the ones that are primarily the ones that are pushing a market into a trending motion. So they put a ton of money in it and they push the market to where it wants to go. And then they cause all that momentum. Other traders sort of hop on board after the fact. And then when it finally gets, that momentum starts waning, they're then searching for value wherever that market has been pushed to. And so then they start trading back and forth. And then we start creating sort of a consolidation pattern, and they're looking for value. Where that auction process, where they're going back and forth, is an attempt to try to find out where value resides in the market at that time. Taking a sip of coffee. So here's a chart that's kind of very illustrative of this point. We can see that this market is comprised of trending and consolidation. So anytime you see a bunch of red bars together or a bunch of green bars together, either going down or up, that's what I'm calling a trending market. And then when they stop and sort of go sideways, that's a consolidating market. So typically you've got bigger players that are pushing it down to some area where they think the market belongs. And then the rest of the market, the short-term and medium-term time frame traders, they then take over and kind of auction back and forth, trying to figure out, well, exactly where is that value. So this is sort of a synopsis of this. And so we have these actors, the long-term, medium-term, and short-term actors. The long-term actors are generally the more professional trader, the trend traders, position traders. But the reality is that most of the professionals are trading in all time frames, where most of the retail traders are only trading either in short-term or medium-term. Hardly ever are they trading across all the time frames. So that's another fundamental difference between the professional and the retail trader. But the long-term actors are the ones that are affecting those big trending moves. They're the guys that really get it going and then maybe add to it. And it's the medium and short-term traders that are engaging in that auction process and establishing or rejecting areas of value. So that's important, either establishing or rejecting. You'll see that very soon. Now, we already talked about this. We talked a little bit about volume profile and what it is. And now we get a little lesson in statistics, although it's not really a lesson in statistics. But if you did take statistics when you were younger, or maybe recently or whenever, if you were in school or college or whatever, you learned about the distribution of data or things. And a lot of times when you first start learning about it, you might want to find a characteristic in a population of people, for instance, like what's the distribution of IQs? And when you look at that distribution and you kind of plot it out, you know, how many people have, say, an IQ of 100 versus an IQ of 70 or an IQ of 150. And most of the people are going to center around somewhere between 80 and 110. And that's going to represent the vast majority of those people. And when you start plotting all this out, it plots out into this kind of bell curve. That's called a normal distribution. And what we're seeing here is this sort of perfect bell curve. This is sort of, from a statistical point of view, this would be the perfect distribution. And not all distributions are perfect. They all, but you know, as a general rule, they follow this kind of distribution. And this is a very, almost a universal type of thing, that almost everything has some kind of distribution that looks something like a bell curve. Now, the important part that we're going to show here is that the vast majority of all the occurrences in that population are something that they put in here in the 34.1%, either to the left or to the right, where the middle here is the most occurrences. That's called one standard deviation, and it's approximately 68% of the population. In volume profile, we use 70% just to round it up. So that's important because we're going to see that in volume profile. And in fact, that's what volume profile is. It is a distribution of volume over different prices. And then we use that one standard deviation sort of as a statistical cue to say that, well, if price is somewhere in there, then the odds are that we're going to stay somewhere within that high value node, or that one standard deviation. And that's the reason why we color it. That's the only reason. It's not, and it doesn't have any significance. The edges of it don't really have any significance, although some people claim that they can trade off the edge of the high value node, or that one standard deviation. But you know, in my experience, it's of no real value. What is of real value are the either edge, you know, way out here to the left or way out here to the right, and the very center where people find most value. So a normal distribution in volume profile terms is just this bell curve flipped on its side. So this is basically what I just said. It's the amount of variation or dispersion of a set of values. So with volume profile, it's the variation or dispersion of volume of a set of prices. And the way we measure it is by trying to identify that one standard deviation, or in volume profile terms, the high value node. And here we're going to see something like that. but flipped on its side. So here's the volume profile. Here's all the volume of this chart that you see here, this candle chart. As this sort of progressed over time, there was a certain amount of volume that was occurring, of transactions that were occurring in each one of these bars. And every time a transaction occurred, it started accumulating over here on the right in the volume profile. So this volume profile is showing you the volume at specific prices. If you went and then just took one of these bars and went all the way across, like, let's take the very biggest bar right here. You went all the way across and added all the volume that happened at that price, all the way up to here. That would then stack up to that one bar. And so you can see it's the biggest bar here. That, that would be the mean on the standard distribution, but here in volume profile, we call it something else. And you can see that we also colored that area dark. That is considered the 70% of all the volume that happened inside here. So one of the things that we can say is that, look, if we're trading in this area, there's probably a high degree of probability that the trade is going to stay, the price movement is going to stay somewhere inside here. Now, that's true, but it can also move outside of there too. But that's just a cue that you can use, and a way that a piece of knowledge that you can use to kind of give you an idea of what the potential behavior of price action will be. All right, another sip of coffee. Let me ask you, are there any questions? Any questions at all? How do you get into volume profile? That's a very good question. So why don't I do that right now? And we'll start with a chart. Let's see, let's create a new chart layout. I'm going to get rid of everything. Remove all indicators. Oop. And all drawing tools. All right. So the way we get into and show the volume profile is we come up here to where it says indicators on TradingView. And that will bring up this dialog. And if you have the, you need to have the subscription version of TradingView. And if you don't have the subscription version of TradingView, you can get the trial version right away, right now. And I think there's like a 2-week trial. And if you do have it, it's relatively inexpensive. It's like 14 bucks a month. But when you do that, it will show you the volume profile right here. I meant to ask, what made you choose volume profile as your choice in reading charts? Well, it's like asking, what led you to drive on roads as the preferred way of getting from one place to the other? And I'm not trying to be snarky there, but volume is the road map to where price is going. So reading volume profile is from a fundamental point of view, this is what traders were doing right from the very beginning. They were reading volume at price. That was their most important indicator. And so when I say, throw that question back at you, why do you use roads to go from one place to another? Because that is the fundamental way to get from one place to another. That's the road that they led you there. You want to find out where price is going, you use volume. So volume profile is the fundamental way to see where price is going, because it tells you what's actually happening in the market. It tells you all about the supply and demand and where value is located and where value is not. So what I mean by where value is located, I mean the masses of people that are trading in the market. Volume will tell you specifically where they, as a group, think the most value in the market currently resides, And then they will also tell you where they think there's very little value. So what I'm showing here, I'm going to choose on the left volume profile. I hope that answers your question. And I'm going to choose visible range. There are 3 different choices. I don't like session volume, by the way. It doesn't really do a whole lot of good. And this would be more in line with someone who's doing market profile. But we're going to use visible range primarily, and then fixed range as sort of a secondary thing. So Eric's saying, when price leaves the high value area, is that when you look at fundamentals more to determine direction? No, but we'll talk about that in terms of a methodology. You know, what I said in the very beginning of the presentation was that I use a very systematic approach, and then the fundamentals and the technicals, that kind of all falls in line with that. I use fundamentals as sort of my big picture view that develops my bias, and then either a directional bias, maybe I'm more bullish or bearish in the market, and then I use that bias as sort of an overlay to my analysis of the market using volume profile. And we'll see that. So I'm going to choose visible range. I'm going to close this up over here. So when I chose visible range, it created this profile on the right, and now it's showing me all the volume at all the specific prices. And you can see the dark area that represents the 1 standard deviation, and then the lighter area on either side. So that's your distribution. Now you notice it's not a perfect bell curve. Yeah, I get multiple colors too. What you're seeing with the multiple colors is you're seeing both up volume and down volume. In other words, volume that was a result of price going up, or volume as a price going down. And so the darker areas are down and the lighter areas are up. Now, I don't particularly find that of any real value. So this is what I do. Now, when you put this profile up here in the upper left, anytime you put an indicator, you'll get a little line up here with some controls. And there's a little gear up there, and you can click that. And right here where it says volume up, down, I usually change that to just total. And then that makes the chart a lot simpler. Oh, you can still only see the, okay, yeah. Sorry about that. Nope, it's my problem. It's me, you know, fumbling around. I chose the application rather than the desktop. I should have chose the desktop. There we go. All right. So I'll do that again. I'll close volume profile. And you notice that there are no indicators showing up here in the upper left-hand corner. Now I'm going to go to indicators, volume profile, visible range. Then it shows me the profile. And then up here in the upper left, it shows me the controls for that profile. So I can either show or hide it. I can add another one. I can format it with this little gear. And so what I'm doing here, the up-down colors, we have all these multiple colors. They make it kind of confusing. The darker colors are showing down volume, and the lighter colors are showing up volume. I don't really need to see that, so what I choose is change this from up, down to total. And so that's the way I like to look at it. So you can see there's a distribution. Now this is a daily chart, and we're seeing Bitcoin over the past, over the past 10 months, 9-10 months. Is the row size relevant? So the row size, well, it depends on how you want to look at it. So there are 2 different ways the TradingView allows you to look at how granular the profile looks. You can do the number of ticks per row, right? So what that's saying is, give me a give me a line, and each one of those lines will mean 100 ticks in price, or maybe $100, I guess. You can also do the total number of rows. All right, so that gives you a little bit more a granular approach, and that will basically, it's at 100, it's telling me that there's only 100 of these bars on the side. Some people like that. I personally like the number of rows, to tell you the truth. Maybe I'll go 200, see how that looks. So for me, that works better, but for some people, they might like the ticks per row. Maybe 80 is good. I don't know. So that's kind of personal preference. And in TradingView, we can look at different time frames. That's 1 day or a daily chart. Each bar is 1 day. We can look at 4 hours. Now, when I do this, it kind of skews the whole chart. And I can come down into the time frame, and I can drag that and bring more information in, like that. And on the price, I can expand that too. I like fooling around with this to try to fill up as much of the window with what I want to see as possible. So I'll arrange it like that. I don't like ticks per row, so I'm going to go to number of rows. All right. So the volume profile, again, this is the distribution. It's showing you the distribution of prices for everything that's showing in the chart. And what is the value area volume number? The value area volume number is the dark area. That's the 1 standard deviation. So let's go to that right here where it says value area. See how it says 68? They chose 68 because that's, remember in the standard deviation, the normal distribution, that a standard deviation was actually 68.2. I like to put that at 70. Most people use 70 as their number. But that's just a way to be able to show you, that's 70% of all the volume that's showing in this chart is contained within that dark area. Are there any other questions? Is that clear to everybody? So the dark area, we try to equate that with the standard distribution. That's like 1 standard deviation, or 70% of the volume. And remember, I said that you could intuitively use that to your benefit in saying that, well, that 70% of the volume occurs in that area, so there's a higher likelihood. And as humans, we tend to use approximately 2/3 as a measure of something significant. And so that's kind of the thinking there, that 2/3 of something is usually the vast majority. In fact, even in our the United States government, we have that kind of rule that 2/3 majority is necessary in order to change anything in our Constitution. So they call that a supermajority. All right, so that's a little bit about the volume profile. There are other types of profiles that we can create. We can create a fixed range profile. And so when we select that, it doesn't appear right away until after we close it and then click and drag. So we click and then we can create a mini profile for that area that we click across. And it's kind of hard to see, so I'm going to change from ticks to row to number of rows, and maybe make it, I don't know, 30. All right. and I can readjust that, maybe go across more. So now we can see the profile for a discrete number of, or a discrete range in time. Which chart are you in? This is XBT USD. That's Bitcoin on the BitMEX exchange. And right now I'm showing a 4-hour chart. Up here, right here is the time frame, right up here. Do you go from local reversal to the next bottom and make the fixed range blocks adjacent? So when I'm doing the fixed range, what I'm really looking for, remember I said before that markets move in one of two ways. They move in trends or consolidations. When I'm using the fixed range, I want to look at the consolidating areas. I don't want to look at the trending areas. So here might be a consolidating area. Let's do another one. Let's move this one over to here. This area right here would be considered a consolidating area. Now I can add another one to this. I'll just add it to where I had it before, from here to here. So generally I'm looking for something that's, now I can make this a default, right? So I can choose number of rows, and let's say I want, say, 32 rows as the default. And then under the template, I can apply, I think you can save it as. Now, it looks like I've saved some here. Let's see what this one does. Oh, I don't like that. That's showing different features of the volume profile. So these are ones that I've saved. That one's not too bad. Maybe too many rows. And then see also it has the up-down volume in it, and I don't really like that. But anyways, I can come up with what I like. And then I can save it as a best profile. All right. So now I can create another one. Let's do it from here to here. Oh. And then I can go over here and say apply best profile. There we go. There's also a way to save it as the default. And you can do the same thing for your session one. You can save it as a default. Save it as a default. Let's save that as a default, so it always comes up that way. That way you don't spend a lot of time readjusting all the settings to make it look the way you like it to look. Now, I am not necessarily suggesting that one way is better than the other. I'm just suggesting that for the information that I want, the way I have these formatted gives me enough and no more. And that's what I like. I like as simple and clean as possible. Just give me what I need. All right, so let's go back to the presentation. We're going to learn a little bit more about all the different anatomy of a volume profile. Now, one thing you probably saw was that was very, and this is a little out of order, but that the profiles aren't perfect. They're not perfect like that. Obviously, this profile is not perfect. And so this is what I'm showing here, that profiles can be just about any shape. They can be like this green one is skewed to the left. This gold one is really long and flat. This blue one is very concentrated in one area. And then the red one is more, evenly distributed. And that's the way real life is. Do you go from a local reversal to the next top? Oh, I think that was an older question. All right. All right, so let's talk a little bit about the anatomy. The volume profile anatomy. Now, if I'm in the Discord or if I'm on a video, a lot of times you'll hear me talk about a balance. And a balance is nothing more than that fixed range profile. I'll say, we're consolidating and we're creating a nice balance. And so what I mean by that is that we're creating what appears to be a normal distributed profile, or something that's closer to like a regular perfect profile. So I'll say, oh, that's a nice balance. It looks nice and balanced where we have a nice bell curve and it looks perfect. It doesn't have to be perfect. I just use the word balance to indicate that it looks like something that is. And often when you see a nice balance, that's what we also call a mature balance. That means that there's been enough price and distribution, and the market has been acting very regular and ordered and uniform. What does it mean? Not much. It's just aesthetically pleasing. So I can also refer to a balance that may be a little bit skewed too, but that's just another word for a fixed range profile that I'll use, balance. Now the value node, this is really important. The value node that you see, at least for most, is that big 70% dark area. The point of control is the very highest volume inside of that value node. And a low volume well is low areas. Now, I'm going to change this around a little bit and say that what I'm really looking for are high value nodes and low volume wells. So we'll go back to this guy here. So a lot of times, well, let's go to a live chart because this is a little bit more real life. So we go to this live chart and get rid of these extended ones. Now notice every time I move it, it recalculates the volume profile because I'm either bringing in more information or less information. So I'm going to change this just a little bit. I'm going to reduce the number of rows just so it's a little bit easier to see. And then expand it so that I can see more of it. I like to fill up the chart. I spend more time, filling up the chart like this, just so that I can see where everything is. And in this particular area, this might, if I just chose this 4-hour chart, this represents that area in April when we had that big, huge move up in Bitcoin. And everyone thought we were going into a bullish move, and then we came down. So that might be a good illustrative point. All right. So here we can see the vast majority of volume is way up here, which is kind of unusual. So there's very light volume down below here. Now, you'll notice that we have high points and low points. Those are significant. They're very, very significant. High points are high value nodes. Low points are what I call low volume wells. Now, the reason why they're significant is that in volume profile, they are indicating one of two things and a certain behavior that happens in the market. When you see a very high value node where you have bars that are sticking way out, what that's indicating is that the market at that particular level, that price level, has found a lot of value. In other words, the demand equation was very high. The market liked it there. And when you see a low volume well, that's exactly the opposite. The market didn't find a lot of value there, and they don't want to be there. So what you can discern from those two different types of features is behavior in price. So when you see a high value area or a high value node or an HVN, as opposed to a low volume well, LVW, the HVN price has a tendency to gravitate towards it and hang out there. So price goes up there, like if you have like a trending market, it'll trend up towards a high HVN, and then start consolidating right in that area. However, when you see a low volume well, price has a tendency to be rejected from that area. So it'll either act as resistance from below or support from above, or when it's going across it, as you see with this right here, this move right here, when it's going across it, it doesn't want to hang out there. It moves through it very quickly. So those are very, very important, and really the cornerstone or the center, whatever you want to choose, corner or center. This is like the epicenter of everything about volume profile that tells you how price is going to behave when it's going near there. So with high value nodes, price has a tendency to be attracted to it. And with low volume wells, price tends to be rejected from it. Now, with those two pieces of information and with the volume profile, we can start drawing lines and mapping out the market structure. And that's what we're going to be spending most of our time doing. All right, there's a question. The auto button next to the log on the bottom right might or should do what you want, adjusting the chart to the zoom. Margins from the top bottom to the windows is adjusted in the settings, cogwheel to the, this guy down here, scales, yeah. Well, thanks. I'll fool around with that. Another sip of coffee. All right. So again, really, really important. And after we go over this a bit, we'll take a little bit of a break, a 5-minute break, and then we'll get into using this. So a couple of things. One is that you'll notice that the POC is here, and by default, there's a line, a red line that is shown. That's the highest volume area. That's the biggest HVN in this chart. Here's another and another. So what we're going to be doing is we're going to be mapping these out by creating horizontal lines. And I create two different types of horizontal lines. Well, two different colors, red and blue. The red ones go on high value nodes, and the blue ones go on low volume wells. And then I'm going to show you how I differentiate between what I consider strong high value nodes and weak ones, and strong low volume wells and weak ones. So by using this, I'll come over here. I don't have to put one on the POC, is already there, but I'll put one here. I got to change the color to red because that's a high value node, and I want it to be solid and maybe thick, medium thick. So then I'm going to put those on others, and I can hold down the control key and click and drag, and that will create another one. And I'll put it on all the major ones. All right. And now I'm going to do the same thing with the volume wells. Here's a well, but I want that to be blue. And then I'll clone those and bring it to the low volume wells. There's an argument that one could be put right here too. All right. So why don't you spend a little time and do some of this yourself too. Now this is going to be really important because as price has a tendency, I said, to be attracted to the red lines and rejected from the blue lines. So, and you can see that just by how price behaves. So the blue lines tend to be either support or resistance. And I know that a lot of you might use moving averages or trend lines or other types of lines that you draw in the chart. But what you're going to find out is all those areas that you think are support and resistance are actually from low volume wells. Can you show? Can you just show where you go to the horizontal line again, please? Yes, in the upper left-hand corner and the toolbar up here. If you click on it twice, you get a whole bunch of choices, and whichever your last choice was, that's what will hang out there. So if I wanted trend lines, I go up here. Also, if you select this tool right here, whatever selection that you make, it'll you won't have to keep on going back and selecting the tool. It'll stay with your cursor, and you can just keep on clicking. That's this guy right here. It's like a drawing tool lock. Stay with drawing mode. I don't particularly like that because I always get confused. But some people might like that. So, as a general rule, I'll start with this this exercise of mapping it out with the daily chart, and then go to the 4-hour chart and map it some more, and then go with the a 1-hour chart and map it some more. Now that's very important. That kind of goes back to my whole systematic way of trading. That I trade in multiple time frames. I'm very interested in looking at the big picture, the daily chart, a more fine-grained picture, a 4-hour chart, and an even more fine-grained picture, a 1-hour chart. So if I were to start all over again, this is probably something that I would do. I'm going to get rid of all these drawing tools. I might start with the daily. And then draw my lines in, and then come up here and then save it. Under some name, or let's see. That's the hourly. I don't want to save that. Rename. I'm going to call it the VP Daily. All right. This one I'm going to make blue. And I'll turn this, I'll lock the tool. Create this one, and this one. Unlock the tool. Move everything around. Sort of make it nice. Exactly. Okay, that looks good. All right. And then I'm going to save this guy. That's my daily. Then maybe I'll make a new chart. Let's create a new tab. Oh, it went way over here. I'm in Chrome right now, by the way. So when I go to TradingView, this is a good exercise. I'm going to put in XBT USD because that's BitMEX. Why am I using BitMEX? I'm using BitMEX because it is by far the highest volume exchange in the Bitcoin world. And so I want the most possible volume I can get. All right, so I choose that, brings me here, and then I'm going to click Interactive Chart. Brings me there. It showed me the VP daily, but I don't want a daily. What I want is a 4-hour chart because I'm making a new chart. Now you notice that when I went to 4-hour, it's still showing me the lines that I drew. Looks like I can add some here. Put one there. Maybe add this one there. Looks like this one can be readjusted right there. Put this right there. All right. So now I have that. So I'm going to call this one. I'm going to rename this one 4-hour. All right, so now I should have, if I were to look at my loading, I would have a 4-hour. Yeah, I don't know how. You have to fool around with this. I get confused with the way they do the saves and everything like that. But anyways, that's what I'm trying to do. I'm trying to create 3 charts: a daily, a 4-hour, and a 1-hour chart. And quite frankly, TradingView, TradingView is a great tool, but some of the ways that you name things and other parts of the tool are kind of quirky. But eventually, what I would like to do is get a daily, a 4-hour, and a 1-hour chart. And I'd like to retain all the lines that I drew from the daily to the 4-hour, and then from the 4-hour to the hour, so that I can see those lines. Because when you get rid of the view, and as you're zooming in, the profile is going to look different because it's only going to be able to profile what's showing on the chart. But I may want to still see the lines that were created in the daily chart because they have significance. So that's why I like to use one chart to create the other. But TradingView doesn't do a very good job at allowing that to happen, or at least the naming part. So maybe the next thing I want to do is create a new chart, a daily. Maybe try using the layer system to group the lines. Oh, geez, you're going way beyond me, Johnny. I've never used the layering system in this, so I'm not like a huge TradingView aficionado, and I'm sure that there's all kinds of tools here that I don't know about. But I use primarily that volume profile. It's also quirky. That's what it figures. And Mario's saying go to visibility, whatever that means. Go to visit. I have no idea what that means. So yeah, really, I have no idea. But anyways, I think you get the idea here. And so what we'll do is we'll take a little break right here. And you can fool around with what you're doing, because mostly everything that we do from here on in is doing some analysis and go through a systematic approach to mapping out this market and then developing trades from it. Oh, double click the line. All right, double click a line. Visibility. Oh yeah, look at that. Learn something new every day. That's cool. I'll try that. Thanks a lot, Mario. Learn something new every day. So let's take a 10-minute break. If you want to fool around with this while we're on the break, that's fine. I'm going to go and just take a break, and I'll be back. Do you have any questions before I go? Yeah. So in the first example, the previous consolidation was the start of the range. Well, that all depends on how much you're showing in your. Now, remember, there are two different types of profiles that we're creating. There's one that we're using to map out the structure of the entire visible range, and then we can use the fixed range to get a more fine-grained idea of what's happening in that particular area, like this. So maybe I want to see this here. And so I can see that right there, that there's a POC right there. So that might tell me that maybe it's a good idea to put a line right there. Because as a general rule, and you know, down here, there's another consolidating area. I would probably want to see more information there. And I do this all the time. I add the visible range, then I add these guys here, so I can see if that POC is going to change, or if there are any other features that will change the value. Now, I could bring in a little bit more information here and see if that affects things. And so when I do that, I can see there's a low volume well right there, for instance. You missed how you put the indicator lines on the chart. In the upper left-hand side where there's a toolbar, you'll see that there's a line up here right underneath the cursor tool. And if you click on it twice, it'll give you all these choices. And you can choose the horizontal line. All right, everybody got that? So I'm gonna go get refill my coffee, and I'll be back in, we'll say I'm back at, well, 10 minutes. That will be 9:30 Eastern time on the half hour. Ernie, do you ever try to align the lines you derive from the volume profile to visible support resistance lines that many will be watching? No, because the visible support and resistance lines that many will be watching are usually derived from price action, which is a second derivative of where the visible support, where the support is actually emanating from. This is the whole point, that the place where people are deciding our support and resistance based on price action is a second order, and usually derived from a lagging indicator or just by connecting dots on charts. But that's not where the actual support and resistance lie. Support and resistance lie from the low volume wells, because that is where the market has found that there is lesser value. That's the whole point. You know, most people are just drawing lines and thinking that's somehow showing them something scientific or pseudoscientific, but it's not. It's not showing them actual objective evidence. And you'll find that a lot of times the volume wells, they are off a little bit from those lines that people draw, but generally they're around that area. But it's the volume well, that's the objective evidence of where there is, where the market finds lesser value. Do you think crypto trades easier than traditional markets? The only thing I like about crypto right now compared to traditional markets is that there's a lot more volatility. What I don't like is that there's far less liquidity. And so for that reason, I generally stay away from the altcoins. And the altcoins are generally highly manipulated. So there's usually some people with just a lot of money that are pushing the price all around. And quite frankly, they're doing that with Bitcoin too, although it's a little more difficult. Everything that I'm showing you here with volume profile is applicable in every market, every asset class. Do I find trading BTC or Bitcoin easier? Well, like I said, the thing I like about it is the increased volatility. And from a trader's point of view, higher volatility markets are much easier to trade because you have something to trade. You have a difference between where it is and where it's likely to go. Low volatility markets, price doesn't move that much, and you don't have as much activity, so there's lesser opportunity to make profit. So I guess that's one of the reasons why I like Bitcoin right now, from a speculator's point of view. So would you say things like Fibonacci and Elliott waves are basically nonsense? Well, in a word, yes. First of all, Fibonacci, they all have sort of a confirmation bias to them. So there's a lot of people that are following these, and so it becomes a kind of I don't know. If there are enough people that recognize a particular level, then that level may have some impact, but generally not. Elliott wave really is just looking at something in the past and a way to map everything. Elliott wave was designed perfectly so that you could curve fit a chart exactly to to the current thing. But there's nothing scientific about it. There's nothing that shows that there is a statistical edge there. And with Fibonacci, there may be something to the golden ratio, which happens to also fall inside that 2/3 supermajority that I was talking about. But if you look at Fibonacci levels, yeah, sure, some of them, sometimes price falls on top of that. And those are the times when people look at it and say, oh, see, it works. But most of the time it doesn't. So I don't know. I would rather go with something that is absolutely objective. Volume is about as objective as you possibly can get. Yeah, self-fulfilling prophecy. That's the word that I was looking for. Or the phrase. All right, so is everybody back? See, the other thing is that with this methodology, you don't need a lot of indicators. You don't need any indicators. You just need price and volume. And if you've looked at some of my calls over the past 6 months or more, you'll probably find that I'm fairly accurate. I mean, I've pretty much nailed the market for the most part, but I'm not trying to say that that will always be the case. And yeah, Archie, that's exactly right. I mean, I would prefer to look at a chart that has as little information, but only the useful information that I need, rather than trying to decipher a bunch of complex things with rules and stuff. What's most valuable here is just having a basic understanding of where the market is right now, where its structure is. When I say its structure, you can think of the volume profile kind of like a landscape. And imagine that you're driving along and there are plains, and then there are hills, then there are mountains. Well, that's exactly what these are like. Those big volume wells are like long, smooth plains where you tend to go really fast through them. Or maybe it's too far to go into it. Like, I don't know if you've ever driven in the desert, but last year was the very first time the wife and I ever visited a desert. And we get out there and we started driving, and it's just flat as far as the eye can see. And you're driving and you're thinking to yourself, man, what would happen if something happened to our car? We'd be dead. So there's some resistance of going too far into it, you know, or you want to zip through it as fast as you possibly can. That's exactly the same analogy for a low volume well. And then when you start hitting the hills and the mountains, you tend to slow down and start navigating them more and find more interesting things, and are attracted to those areas. And that's, I guess, another analogy for the high value nodes. You know, another way you can look at the low volume wells as kind of like a fire walk, right? You get on there and you just want to walk as fast as you can right through it. And if you look very closely, you'll see that most of those areas, the blue lines, price either zips through it or it uses it as support or resistance, like right here. Zip through, support, support. Zip through, came back up, support, support. Zip through, came back down, support. Zip through. And then the red lines tends to congregate around the red line, the high value node. Now, one could make the argument that there is a well right here, so we kind of zip through. And there are occasions where we zip through a high value node as well. But that's kind of an anomaly. But zip through this one, this whole well right here, zip right through it, then came down and consolidated. Oh, geez. I'm so sorry. I can see the chart. You can't see the chart? There you go. So what I was saying was, starting over here on the left, we zipped through, hit resistance on that well, came back down, hit support here, came back up, started consolidating around this line, zipped through this volume well, came up here, and now this is a bigger feature, a lot of volatility here. But over here, you can see we zip through, consolidate. One could look at this area and call that a low volume well right here, kind of zip through it. But this was this trending here, this right here. We don't always have to respect all the features. Sometimes, like in this move here, this was the result of some whales, long time frame players, actors that are coming in and just pushing this thing all the way down until there's an area of where the rest of the market then decides that, hey, I'm going to try to find out if there's value here. So they start auctioning back and forth until they settle on that and start creating a nice balance. So this is a 4-hour chart. And if we start going into like a 1-hour chart, you can see even more detail and see more of this, these behaviors. I don't really need this guy here. Might add more bars here just so that I can see a little bit more detail. So we can go into a little bit more detail and continue with our line drawing. See, one thing you can tell is, you know, if you're drawing one of these lines and just moving it across, you can see all the different areas where it used it as resistance. Now, it's not always perfect. And see, that's the whole thing with support and resistance lines. A lot of people will choose various very specific levels, and it's always not specific. Sometimes it's a range. But we can see that right here seems to be like the ultimate area right there. And there's a lot of times just came right up to that line, turned around, all these different areas. So there's something about that level, but it's not exactly that level. It's probably a little bit above, a little bit below, but it's about that level. So interested to hear how you could tell that Bitcoin was headed towards consolidation. Well, let's say that we're down here and we're moving up. As we're moving up, the profile looked very different than it does today. Might look more like this. So we're down here on the bottom and we're thinking, okay, we're going to move up. Where are we going to move up to? Well, or what are the odds of moving up? At the time, I was making scenarios where we might move down, we might move up, but I was using, long time frame, medium time frame, short time frame. This is an hourly chart, so it's very short. But each one of these high value nodes are targets of where I think volume will have a tendency to go, and each one of these low volume areas are resistance points or areas of rejection of price. So when it envelops, you look at where price gets pushed. Now, obviously right here, price got really pushed. And so when it comes up to that area, my natural inclination is to think, okay, we're going to start consolidating around that high value node that existed from before. And that's exactly what happened. So here's the high value node up here. And then you can see as we got pushed up there, that's where we went. It's a little bit more complex than that. We start developing scenarios, and that's what I'm going to go over next. And how did you determine that we're not going to drop anymore? I didn't. As a matter of fact, I thought we were going to drop. I thought there was a better chance that we would drop. So let me say this. earlier on, I said that my analysis was fundamentally driven, and then I used the technical analysis to kind of model those fundamentals. So what I'm saying there is that I develop an overall bias to the market, and that takes in a whole range of different factors. You know, in Bitcoin, that has to do with how many people are participating, what's the sentiment, regulatory issues, all kinds of things that kind of go into that, as well as, you know, we're in a bubble, and bubbles have a certain pattern that they follow. I also look a little bit at some chart patterns if they have a statistical significance. And so one of the things that I want to go over before we go too far in this is that I want to tell you that I look at chart patterns, and actually the chart pattern is one of the reasons why I felt price was going to go up a little bit, but after the feature happened. So I'm going to show you the chart pattern, and then I'm going to show you the site that I refer to and use that information. And the reason why I use this particular site and its information is that the person who created this site, his name's Tom Bolkowski, has done unbelievable work in analyzing millions of charts and done statistical analysis across hundreds of chart patterns, and then he's ranked all those chart patterns. And so I'm only concerned about the very top ranked chart patterns that he's created. In fact, I have them, let's see, do I have them on this? I have them on Safari. Let me bring this, I'll bring my Safari to the top. I have them all bookmarked, the best candlesticks right here. All of these are from Bolkowski. These are the top 13 candlestick patterns. And so when I see these, any of these patterns, I use that as an overlay to my analysis. Now, and you may have seen many of my videos, if you saw them before they were taken down, where they talk about this. Now, you have the bearish and bullish engulfing. The most recent one was a bullish engulfing. So I'm going to just do a search for that. Bolkowski bullish engulfing. It's called thepatternSite.com. So let's take a look at this pattern right here, that graphic. Can make it bigger so everyone can see. All right, so we see that graphic, that pattern right there. And then here's the statistical workup that he's done on this, that it indicates a bullish engulfing indicates a bullish reversal 63% of the time. It doesn't happen too often, so that means that its ranking is relatively low. It happens about 10% of the time. But its performance ranking is pretty good. In other words, that it reveals or performs according to its statistical history of performance pretty good. It works best when it's a bear market with a down breakout. So in other words, it's coming down in a bear market and then breaks out. The best average move now, this is kind of interesting, in 10 days, is that it actually goes down, but at first it does go up. Now, this is the interesting thing, and one of the reasons why it's not in my top 10. However, I'll explain in a little bit. What he says really is that the best move in 10 days after an upward break is a drop of 1.18%. You'll find that what he's saying in here is that it has a tendency to have a reversal followed by a continuation of the, if you read the whole thing, followed by a continuation of the downward move. So we have this bullish engulfing. We have a tendency to go up, but then revert back down. Okay. So given that information, this is what happens most of the time, or the supermajority of the time, according to Bulkowski. All right. So let's take a look at that from a daily chart point of view. On the daily chart, here's the daily chart. Now what we're talking about here is right here. So we're going to expand that so we can see that on a daily chart a little bit more. All right. So right here, we have a bullish engulfing. That means that we have a big up candle where the body totally engulfs the previous down candle after a downward bearish trend. So this is exactly what he's describing in here. And then showing this right here. So after you read his entire dissertation, you start realizing, well, what he's noticed under certain conditions and the context of which this pattern will live is that this is, what he's describing the best case, a downward trend, bullish engulfing. We have a tendency to go up a few percentage points. So, and then after that, continue down. So the odds are that we're going to do something like this. We're going to go from here up like this. And then after about 10 days, start moving down like that. Continuation. That's the majority of the case. But is that the only case that can happen? Of course not. We could also potentially, zip up this way. And so where would we stop? I don't know. We would probably stop where there is a high value node. So if I were to, zoom out a little bit and make a scenario here, then I would say that we're probably going to maybe potentially come up to here. Let's clone this line. Maybe continue up to here. But also we have this low volume well here. Right there. Maybe we go up to here like this. This is another possibility. So what I do is I develop scenarios. Now keep in mind that my overall bias is still bearish. So I'm putting a lesser degree of probability on these upward moves, but probably a fairly high degree of probability on this move right here, this initial move up into this very strong, what appears to be a very strong volume well. So that should be really good resistance. And then after that, we're probably going to come down just as Bulkowski describes. Now, where will we go? Probably to the next high value node, which it happens to be right about here. But in the way, we also have this other volume well right here. So I can even see us maybe pausing here or potentially moving through it very quickly. Again, I'm developing scenarios, all based on the behavior that I know to be, how this stuff works. So maybe something like that. Um, well, I did probably talk about a consolidation before that happened, but I also talked about potential things that happened there. When we came down here at first, we were hitting a volume well, and I thought that there would be some resistance there. And then I did say that we have, this area, that 7,400 area, 7,500 area, that I thought we would consolidate. And so if you go back and you look at some of my work, I do talk about this whole movement in detail. And this entire movement, I did call all of the behavior here. So, you may be confusing that with, I don't know exactly what you're referring to in particular, but I've been using volume profile as it's been coming down, kind of calling all those particular features and how it should behave. So maybe when I get to the 4-hour chart. Yeah, so I did on this particular move here. My prediction was that it was going to hit at about I think I said 76.50, and I thought there was going to be a consolidation there, which there was. And then I had predicted something lower here. And then when we got this move up, that's when I reverted to my Bulkowski chart analysis, and then started to follow that. And so now my general feeling is that we're going to be moving up until we hit this low volume well, and maybe after 10 days or so, maybe not necessarily 10 days. It could be 5 days. It could be 12 days. I don't know, but I'll have to see what happens as we hit this area. If we bounce right off that, that's my main prediction, is that we're going to bounce off that low volume well and start moving down. All right. So I take all of that into consideration. Now, this is really showing you the methodology. Using some very, very simple things. First, I use my overall fundamental analysis of the market, and that will give me some kind of bias. And I just put some number on it. If I'm 50-50, then I'm neutral. If I'm 70-30 bullish, then I'm bullish. Maybe I'm more bearish. I'm maybe 30-70 bearish, right? And so then I use that bias as an overlay to put some, if I had a choice of, am I going to go up or down in the near term? Or do I have a choice now remember, I also look at this in 3 different time frames: the daily, a 4-hour, and then a 1 hour. 1 hour may be bullish while the daily is bearish, if that makes sense. So I will do this kind of analysis in all those different time frames, and then consolidate them all up, and then try to figure out, well, what's the, what type of trade am I going to do? Am I going to do a longer term trade or a shorter term trade? And then figure out, well, where the odds lie based on my analysis, and kind of add it all up. Now, a lot of times what I'll do is I will, this is what I do all the time. The lines that I draw, I don't draw them at the same thickness and the same color. If I feel it's a very high probability move, then I'll make it very thick. Oh, this is the thickest line you can draw right here. If I believe that this is a lower probability, then I'll make it less thick, like that. Or maybe make it a different color, like that. All right. So that is generally what I do. And I never pick just one possibility. I always look at all the possibilities, because every time price moves to a different level or hits a different feature, it's going to behave differently, and there may be a pattern that may evolve or whatever. So you have to take all that into account. So you do this, and then along the way, you know, you're going to get better off. You're going to get overall better trades. Now, so now we're back here. We're in the daily chart. We have a bullish engulfing. This is probably the best scenario. Now, if I turn that into a 4-hour chart and saw all that at this scale, I start seeing different features, you know. I see another high value node right here. So now I'm thinking that, well, if we do start coming up here, even though this is a volume well, we'll probably move fast. We probably won't go all the way up to here. We'll probably go to here if it took that path. And then if we came down here, I would say that there's a good possibility that we might do something like this. Maybe do something like this. Do you provide trend alerts or trade alerts? Well, if you follow me on Discord, I am talking about this all the time. Also, I am providing a daily program on Twitch, and where I talk about the analysis, and I also talk recently I've been talking mostly about systematic approach. Now, before this all happened, where we are here now, I had a different look at this, and I had an upwards and a downwards bias. Of course, as everything changed, then you know, my downward bias, that kind of went away. Then I had to switch to my upward bias and then do a reevaluation because it moved away from what I thought was the most likely thing to happen to something that was less likely. Now I have to do that whole thing over again and say, okay, where am I going this time? And then place my bets accordingly. So if I think something is very high probability, I'm going to then probably take that trade and then look at and evaluate it, manage it as it's moving across the landscape of the volume profile. It's not, you know, it's very logical. Now, one thing that most people don't take into consideration is that I am also, at the same time I'm doing this, I still have that fundamental bias. I can't emphasize how important that is. And I'll give you an example. This is a 4-hour chart, so we're going to go back to April, mid-April, when we had this huge move up right here. This bar right here, this big green bar, that was the single biggest volume bar in Bitcoin history, that bar right there. And if we went and looked at this in a bigger time frame, actually that wasn't it. Yeah, that was it. Yeah. This downward move was a huge downward move, which I called almost exactly, by the way. And people, you know, I thought it was going to consolidate and continue down. But what happened was some huge whales came in. They injected almost $7 billion and pushed this market up. And then they continued to push it up. Now, I thought that there was going to be a limit to how far that they could do it, and I was really unbelieving in this move for one fundamental reason. Again, fundamentals, because I went back and I looked up Google Trends. I'm going to do that right now. because I wanted to see whether or not what I was seeing was new people coming into the market and participating and start getting in and getting excited, or was this generated strictly by someone internal to the market? And one way that you can see that is by going to Google Trends and simply type in Bitcoin. And this will show how the general public did the general interest in Bitcoin. Now, I'm going to show you what Bitcoin, not for the past 12 months, but maybe for the past 9 months. Let's see. Maybe since October. Okay. So if you were to follow this, this interest in Bitcoin, and then overlay that onto the price of Bitcoin on a daily chart, and let's do that. So we have, you know, this bubble that happened where we're moving up, and then we come down, move up and down. And you compare that to what went here. We had this bubble, we moved up, down, here. And then after February, you'll notice something, that the interest in Bitcoin just kept on wavering and waning, and lower and lower and lower. If you were to map all of these different moves, let's go look at the 12-hour, might be a little bit. You can see, you know, these moves here map almost precisely to these moves, up, up, down, etc. Actually, to here. This move right here, starting in April, right there, where it moved up. Why don't you take a look, a very close look. Right here is that day, April. Do you or do you not see any move up at all? I don't see any move up at all. As a matter of fact, it kept on going down. So what that told me from a fundamental view is that that move had nothing to do, this bullish move had nothing to do with the general public's interest in Bitcoin. That was completely a manufactured move by big whales or exchanges or whatever. And so from that, that was part of my fundamental analysis. And I looked at that and I said, man, that's a fake move. And so once I said, I'm going to wait for it to move up to a certain extent and then start seeing if it kind of wanes. And it did. It waned right here. And this was a very, very important day right there. And I'm going to zoom in on it. So we moved up very strong, a big push here, and then there was a big push here, and then another huge push right here. But see this reversal right here. Now I have a way of analyzing that volume. I call it my volumetric principles. And to me, that told me that here we were getting sound rejection. Actually, right on this candle here. And so from that point on, I said that, okay, I think that eventually we're going to start moving down. Now we may move up a little bit, but my general strategy from that point on was to short every single rally. So I didn't get in until there was a rally, and then I shorted it. And if you were following me on Discord, and watching my videos, that's exactly what I was saying. I said every rally, every time there was a rally, I said I'm shorting it. And I showed my trades actually in Discord. So I shorted this one, I shorted this, I shorted this, I shorted this. This one we caught a big one. Rallied short, rallied short. And my idea there was you just keep on shorting it because there's, you know, obviously no public interest. There's no new money coming in until it stops working. Well, this is where it stopped working and where we exhibited a pattern, a very highly reliable pattern that I had to kind of reevaluate. That, and also the fact that we're down, starting to come down to this big volume well where there's a lot of resistance or support, I should say. There's a lot of support there because there's simply a big volume well there. It kind of drops off. See how volume just drops off dramatically. So I really felt we were going to come down to this guy right here to 6,800, but we didn't. We stopped here, and it appears that there was another pump up here, caused a bullish engulfing, and now that's going to just change my attitude a little bit right there. But I still believe we're going to come down to this value node eventually. And according to Bukowski, that's probably what we're going to see. So that gives you kind of an overview of how I'm approaching this market, and then using volume profile in my fundamental analysis and high probability chart patterns to use that all together to try to predict the most probabilistic place that that price is going to go. I mean, it doesn't require a huge amount of talent per se. It's just very objective evidence, but it's using those three things. And you have to keep on putting this in your head. It's all about the fundamentals first that provide your general direction. You know, right now, let me give you some other insights. So I'm going to now do a longer term projection. And I need to stop sharing and to show my, because I talk with my hands, right? Got to get some coffee for this. So from a fundamental point of view, Bitcoin is definitely in a bear market. We just popped a huge bubble, and bubbles have certain patterns that they play out. All bubbles have the same patterns that they play out. But you juxtapose that with another fact, and that is that there are some people in this market that don't care about how bubbles play out. They don't care about how patterns and supply and demand, and they try to manipulate this market and push it up for whatever reason. Now, one of the big reasons that they push it up is because the exchanges are when price goes down, interest in Bitcoin goes down, and the number of transactions that occur, trading transactions, goes way down. And so those exchanges that were really powerhouses of bringing in the cash are starting to like lose a lot of money. And so my belief is that they, along with, in collusion with whales and miners, are incentivized to try to pump these markets up. Now, some people would say, well, that's manipulation, that's illegal. Problem is that Bitcoin is largely unregulated. So it's, whether it's illegal or not, it's happening. Now, in a couple of months ago in March, we had the G20 meeting. And there were a lot of people in there in the Bitcoin community that thought that you know, they were going to come up with some sort of regulation around Bitcoin, but they paid very little attention to Bitcoin, although they did pay some attention to it. And the whole Bitcoin universe was all hyped up on this because they didn't really say much. They felt like they were giving it an okay. That's because everybody in the Bitcoin world and in the altcoin world are positively biased because they're out of their minds. They're in a cult. They don't see the big bubble that we just came down in. They don't see the fact that countries are worried about this. They don't see the fact that big banks, the IMF, the World Bank, looks at Bitcoin as a direct threat to its survivability. And if you think that all these big institutions that basically control the world are going to sit by and just let Bitcoin roll over it, well, then you're nuts. Well, unfortunately, that's what most people in the altcoin and Bitcoin world think. So I can only conclude that they are nuts, or they're temporarily insane, because they are smitten with this idea that they're going to make 10 times, 100 times, 1,000 times their money like they did last year when we went into the bubble. Unfortunately, that's primarily their only experience in trading. And they haven't been through multiple bubbles like I have, or have a more global macro view. They have a very myopic view. Now, one thing that the G20 said at the conclusion of their meeting down in Argentina, G20 are the 20 biggest financially strong countries in the world, including the United States. One thing that they said was that they were going to address Bitcoin, but they needed more information. So they were setting a task force called the FATF to go out and make recommendations on regulation. Now, again, Bitcoin people in the Bitcoin world and altcoin world thought, oh, this is great. They're all going to be wonderful regulations and they're going to be in our favor. Well, I don't believe that for a moment. But they were tasked with coming back with that information in July. So this is what I think is going to happen. We're talking about July. It's not too far away. Let's see if we can we do a vertical line? So in July, mid-July, they're coming back right about there. Let's make that line big and thick and colorful. Let's make it purple. All right, there's the July date. Here's my my prediction that we're going to continue this kind of oscillating move, which usually happens. Typically, we should be coming down the long-term regression line. The long-term regression line, if you go back all the way in Bitcoin's history. This is another feature of bubbles, by the way. Let's see if this will draw it. Come on, draw it. I don't know why it doesn't want to draw the long-term regression. Let's do a weekly chart. Well, maybe BitMEX doesn't have it. That could be. They don't have BitMEX information. Well, let's just say that if this went all the way back to 2011, there's a long-term regression line that looks something like this. Goes from here, like this. Something like that. As a general rule, when you have a bubble, you will, all bubbles eventually pierce that long-term regression line, overshoot it, and then come back up, and then kind of go sideways. So again, this is part of my long-term fundamental analysis. So I still have this in mind, and it's in addition to the reason why I think we're going to go down further. And if you look at that long-term regression line and then compare it to our current move down, I can draw another regression line from the top of the market to where we are now. I'm going to draw a regression channel. A regression channel is just the best fit line and channel of where prices have gone and where they're likely to go. So if I click, I can come down here to the regression trend, and then I'll just draw a trend line from here to the present. All right. That's a 2 standard deviation channel. Let's make it a 1.5 because it's just a little bit too big. 2 standard deviations covers about 90% of all cases. 1.5 covers about 80%. probably good enough. So this is the general direction of price since the bubble burst. Here's the long-term regression. Now, obviously, it looks like we're going to come out a little bit further, but it looks like we're probably going to meet these two right about here, overshoot, and then come back up, probably into that G20 meeting, because there's going to be some kind of, I'm sure there's going to be some kind of news or elation or something where the market's going to get kind of hyped up, and they're going to try to push that price up until the G20 meeting or the G20 findings. When they have those findings, I don't think they're going to be negative. I mean, I don't think they're going to be positive. I don't think that they're going to be positive at all. But I think that the Bitcoin world, oh, you can't, damn, I keep on doing that. Screen share. We can't see the chart. I should be looking at your words there. I just get so involved. So anyways, everything that I've talked about was this regression channel. And then the long-term regression line that I created was this big, long purple line. I couldn't draw it perfectly because the data doesn't go all the way back. But if you use another exchange, you can get data all the way back and then draw a regression line through all the way up to today. And so here's the long-term regression line. This is approximately, if you took a long-term regression line of gold, for instance, and just drew it through, you would see that it generally over decades follows along that long-term regression line. And it's probably a pretty good projection about where price is going to go. So if we were to look at this, this is probably a pretty good projection of where Bitcoin price is going to go. Now, we may go into another bubble after this. I don't know. But what I think is going to happen is that event right there is going to be the event that's going to bring us below that long-term regression line and complete the pattern of a bubble. Now, the basic pattern of a bubble is that we have usually a bear trap here and here. We go up to a blow-off top, come down hard, create a secondary top, come down hard to capitulation, and then we go through a series of sort of oscillations until we go below and overshoot the long-term regression, and then come back up and then start moving sideways. All bubbles follow that exact same path. If you look at a mapping of any bubble that's ever occurred, some of them are fatter, some of them are skinnier, some of them go higher, some go lower, but they all basically follow the same thing. So if that's the case, then I think we still need to go below that, or dip below that long-term regression. So that's going to happen sometime. I think that G20 meeting is going to be that time. So my prediction is that we're going to crash after that meeting, go below there, find a bottom, and then start moving up again. But we're not going to move up and make everybody's nirvana come true unless something else fundamental happens here that adds to that situation. So that's my long-term view. Now you can piggyback off of that view, you can add to it, or you can develop your own view. And it might be a competing view. It might be something similar to mine that maybe comes to the same conclusion or a slightly different conclusion. But that's a fundamental thing in your analysis that you have to do. You're going to need to have that long-term view, that medium-term view, and that short-term view. And then let that kind of guide and be an overlay to everything that's happening along the way. Then use your analysis with volume profile and how you know price will behave as it goes across high volume nodes, has a tendency to be attracted to them, and low volume wells has a tendency to be rejected from them. Develop multiple strategies or multiple scenarios of where you think price is going to go. Let's see, I'm going to write all that down. Where can I write it down? I'll write it down on, Scrivener. Okay. Strategy. Let's make it nice and big so everyone can see it. Develop an overall fundamental view of the market and a directional bias, either positive or negative. Two, so, and there's a lot of stuff that goes into that. And it's constantly being updated. So two, map out market structure in multiple time frames. So in my case, I do daily, 4 hour, 1 hour. All right. Then create both bullish or create scenarios, both bullish and bearish, using your bias to weight their relative probability. What does that mean? So that's very similar to what I was doing here. We'll zoom in on that. So is all of this making sense so far? So I develop multiple scenarios, I weight them, and I can use colors, I can use thickness of line. I might take a screenshot and then maybe add more graphics on top of it and annotate the charts, and use all of that as my my guideline to figure out how I'm going to structure my trades, how much I'm going to allocate to a trade based on that analysis. Obviously, if you think something's a higher probability, then you might get more aggressive with that trade. If you think it's a lower probability, you might get less aggressive or not take the trade at all, or wait for something else to happen to give you more confirmation. Create scenarios, both bullish and bearish, using your bias to weight their probability. Use graphics and annotations to illustrate your analysis. That's really important. Get really visual. And 5, take trades or don't trade based on take trades or don't take trades and size them based on the probability. I think that's pretty straightforward. So now you have kind of a strategy here. Now, this is a very, very generic strategy, but it's highly effective, and it's looking at the market, from a big picture lens. You can get much more fine-grained, detailed, and particularly in the shorter-term trades. This is probably a very good strategy for your position trades, maybe even for some swing trades. But what do you do when you start getting into more fine-grained details and events that happen that you're trying to take advantage of? And how should you overall allocate your capital? Should you be only doing long-term trades? It really, a lot of this depends on your availability to the market, how much time you have to actually spend doing the analysis. This is the amount of analysis that I'm showing you here isn't a whole lot, and anybody even with a full-time job can probably do this, and in their spare time, and at least come up with a very good picture of doing, say, longer-term trades. Maybe that might last weeks or months in the market, or even shorter-term trades that might only last a few days or maybe a week in the market. If you wanted to get even more fine detailed and start doing the more intense shorter-term trades, then you're going to need to develop strategies that are much more in tune to those things and find an edge that actually works. And even here, you need to have some kind of edge. And right now, we're using our probabilities and our knowledge of how markets behave as they cross over this market structure, in order to develop that kind of edge. But you don't really know what your edge is until you start working it for a while. And like I said, in the coaching sessions, that's something that I'll help you develop. That's primarily why I'm hoping that people will do that and start using that technique to be a lot more systematic on the way you approach things. But here is a very high-level system. Oh, I got to sneeze. Excuse me. So this is a very, very high-level systematic approach, and it's very useful and very accurate. And if you stay at, being more of a trend trader and maybe a swing trader, you should be highly successful with this sort of strategy. But, there's a lot more to it. I mean, it takes a little time to become proficient with this and to be able to predict these things to some level, some degree. It's one thing to come up with a bunch of these scenarios. It's quite another to choose the one that happens more often than not. Now, so that's the that's the biggest thing that I want to say here. Don't expect to be able to jump right into this and then kill it every time, that you're going to peg it, because I don't, nobody does. And so now I'm going to provide you with a kind of another overlay on this systematic approach that that you might want to think about, and it's something that I want to cover in our individual sessions. And that is that the thing that works best, and the thing that separates a professional trader from a retail trader, is that the retail trader tends to do one thing. They work with one asset class, one strategy, one time frame. And they think that that's it. They're going to get really good at that. And then they substitute technical analysis with a strategy. Technical analysis is not a strategy. it's hardly even, it's not even technical, and it's hardly real, I guess it's a form of analysis, but I call it a swag. And what that stands for, that's a military term, that stands for scientific wild ass guess. Now, there are different types of technical analysis that can work, better than others. And what I'm presenting you here is the primary technical analysis that most professionals use. This works better than any technical analysis that I've ever seen, and has more probabilistic outcome. It's simpler, and it actually gives you an objective view. And most importantly, you're working with the market in real time. You're not working with lagging indicators trying to take things that developed in the past to predict the future. What you're doing is you're taking things as they stand today. Now, what do I mean by that? This is something that I didn't really cover. What do I mean by that? That's the way it stands today. Well, when we see a high volume profile, a high volume node, we say, yeah, but that all built up over, over time. That's true. However, when we come across any of these nodes in real time, like this high value node that we have right here, those are positions that still exist today. So people that were in the market here and back here that made up this high value node, they're still in the market today. Not all of them, but enough of them to make that volume node significant. And it is the reason why price behaves the way it does in the present, because that is the present market position of many people over the, whatever amount of time that you're showing in that chart. Now, of course, if you go to the higher level charts, there's even more people, and these nodes will become even more exaggerated. But that's why we can make these predictions about the way price moves, because those low volume wells and those high volume nodes represent the current condition of the market, the current supply and demand, where the market currently, at this present moment, finds value or not. And that's why it works. That's fundamentally different than looking at an RSI or a stochastic or a MACD that are evaluating stuff over a period that might only be 20 bars back. They don't even look back beyond that. They only look at back, 20 bars, but you're trying to discern what's happening in the market now by something that happened in the past. Doesn't make sense. Do you associate the low volume well with demand? Actually, it's the other way around. I associate the high volume node with demand. So the higher the volume, the more value. But I don't even look at it, from, is it supply or demand? As there's more volume there, there's more supply. And as that keeps on building up, that's supply feeding that demand. The demand is eating it up. And I guess you could say that when you have a low volume well, there's less demand and maybe more supply. So yeah, I guess that's the way you would look at it. You would say high value nodes, it's diminishing supply and increasing demand. Low value nodes, it's increasing supply, diminishing demand. So any questions on that, that kind of view of the market? All right, so I want to get back to this sort of systematic approach and what differentiates the professional from the retailer. As I said, the retailer tends to focus on one thing, one time frame, one strategy, and the strategy isn't even a strategy. It's just technical analysis, which is nothing more than a modeling of the current market as it may be or as it was in the past. A real strategy is one that has developed a hypothesis, one that uses sort of the scientific method. I don't know, let's look up scientific method. Oh, this is a good one right here. So scientific method, we make observations. Now, let me just make it clear that when we're in the market and we're trying to figure out what to do, this is a method that you should be going through every time, developing some kind of hypothesis that you can prove, or that you can at least give yourself a degree of certainty. And then over time, after experimentation, which will come into your trades, you start developing that hypothesis into a general theory. Right? Now you have a strategy that you can use. Once you have a theory, you have a strategy. But it all starts with developing a hypothesis. And that's by making observations. What is it that you actually see and can actually observe? And then thinking of how that might have been affected, or the scenarios that it might entail based on your idea of fundamentals. Formulate a hypothesis. That's our idea of maybe creating scenarios of how this might behave based on that fundamental view and our analysis of those things that are happening in the market at this moment and its market structure. Develop testable predictions and gather data. I guess that means actually trade, or do a simulated trade or a real trade, and then see what the results are. And over time, you start developing either a certainty and moving towards that hypothesis or moving away from it. And then that will turn into what you consider your general strategy. Now, let me just say this, that a professional trader trades multiple strategies. In other words, they have a number of these different strategies that they develop using this kind of scientific method. And they try to employ as many of those strategies as they can in the market in multiple time frames, with a large group or a wide set, or at least multiple asset classes. So that's the other fundamental difference between a professional and a retailer, where a retailer is looking for one time frame, one strategy, one asset class. The pro is looking in trading multiple strategies, multiple time frames, multiple asset classes. The other thing that the pro does and understands is that the longer the time frame, the higher probability of the trade. The shorter the time frame, the lower probability of the trade, except for one specific area, and I'm going to show you that next. And then that will be the end of the presentation. So they allocate their strategies and the trades that they perform in the market based on that fundamental knowledge, that the longer term strategies have a higher probability and a greater return. So that's what they allocate most of their funds to. The shorter term ones, they allocate less, if any. Now, the average retail trader does exactly the opposite. All right, so I'm hoping I'm illustrating the difference between these two. And maybe that will tell you what you should be doing, or what makes more sense to do. Would you prefer decelerated strategies, or doesn't matter as long as each is sound on its own? I'm not sure what you mean by decelerated strategies. When do the wells and nodes act like support and resistance? Okay, so the nodes don't act like support or resistance. They act as attractors. They can almost be targets of your strategy. So in other words, in general, I'll get to the Costas, I'll get to your question in a second. In general, it's best to take trades from a low volume well or a blue line, and then use the high value node or a red line as your target. So as an example, in today's current situation, I would be looking at taking a short somewhere around the 7,800 area, and then going short, and then maybe my first target would be the 7,400 area. My second target might be this other volume well. Maybe take the trade off completely. But if it falls through it and zips through it, I might keep a little bit on and maybe have a third target of this 6,900 area. All right. So I'm looking to take trades from the blue lines and towards the red lines. Oh, decorrelated. All right. Yeah, I'll talk about that in a second. Will you talk a little bit about where you generally place your stops? All right. Well, see, that's gonna kind of blow your mind. I don't use stops, and the reason why I don't use stops is because of the overall strategy that I use and the diversity of strategies. And this goes back to Costa's question on, do I use non-correlated strategies, and it doesn't matter as long as each one is sound on its own. So I do have some stops in mind, but they're usually really, really big catastrophic stops. By trading multiple strategies and trading small in each one of those strategies, and making sure that each one of those strategies that I develop are very, very unique or different from each other. In other words, they're non-correlated to each other. Then they all act as kind of a natural hedge to each other. Now, this takes a little time to develop, and you can discover some of these strategies, right away by maybe working with a mentor or somebody else, and they can point out things. But the idea is that you want to diversify your strategies, make sure that they are very different from each other, that they are across time frames, across asset classes, etc., and that you trade them all together, and each one you allocate a very small amount of capital. So that was another point that I should point out but that's getting down to more process. So when I get to, here's some other rules of trades. Really, really, really small. You can always add to a position if it's going your way, but you should start out all your position sizes really, 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 I'm going to add one more, really small. You will find, and when you do this and you're trading multiple strategies, there is no need to have stops. As a matter of fact, you can have a position that goes wildly off course. And because it's small, it's not something that you're going to fret over. But you might say, well, it doesn't look like it's going to work out. I'll just take it off and it's no big deal. Or you can wait and give it some time to develop, and then it might turn around and then turn into a winner. When you trade really small, you have that kind of flexibility. When you trade large, you don't have that flexibility. When you trade with stops and you trade with too much leverage and too much size, you're almost guaranteed to lose. Yes. So all of those things, as I said, Johnny, are combined. You have multiple strategies, multiple asset classes, multiple time frames. Now, that sounds like a lot, and you may only have, say, 1 or 2 or 3 strategies in play at any one time on different asset classes. And this is what I want to talk to you about when we start getting into our systematic approach, how you kind of build all this up and develop a whole library of strategies that you can employ, but you're only employing them at certain times, when they're necessary or when they make sense. and trading small. And I can guarantee you, by trading really small and trading in this this method, that you will become way more, that your chances of becoming very successful at trading are very high. All right, so now I promised you that I would get to a shorter term time frame and show you tensor charts. So tensor charts is a pretty cool tool. It is a charting tool that is based almost exclusively on order flow and volume. And so if we take a look at the chart itself, so here's a 5-minute chart, or actually this is a 15-minute chart of the current market, and we take a very close look at it, you'll see that each of the candlesticks have been broken down so that you can actually see where the volume is and what kind of volume it is all along at different price levels inside the candle chart. And you can see volume profile over here on the right. And then the candle has these sort of graduated colors. Green would be bullish and red would be bearish. And so you can actually see, what's happening inside the candle. So we have the body of the candle, which represents the open and then the close, and then above that is the wick. So you get a very, very precise view of what's actually happening inside. This is called a footprint chart. And generally, if you wanted to get footprint charts and see them and use them as a professional trader, very, very expensive service. And this is all for free. Of course, it would require you to understand it and then be able to use it and so forth, but that's just another story here. I'm just saying that this is a great tool. The most useful tool are these tools on the right. Way over to the right is what is traditionally called a time and sales, but these are actual sales of either bullish, buys or sells that are happening in the market in real time. And you can see the color and the intensity of the color is the size of the trade, and whether it's bullish or bearish, or a buy or a sell. And then this tool down below, the trades counter, is a way to filter those trades that are coming out within certain time frames in their size. So this trades counter, I have it set up so that it looks at 2-minute intervals. And the first bar is for trades that are between 0 and 1 Bitcoin. The second bar are trades that are between 1 and 2, then 2 and 3, then 3 and 5, and then 5 to 40. So here, by using these, right now you can see it's mostly a bullish move that's coming in, more bullish than bearish, except for on the big size, the overall. Here I can very clearly see orders flowing in or flowing out of Bitcoin, or bullishness flowing in or bearishness flowing in. So I get a very good sense of order flow here. And once you become proficient at reading this, you can become very, very skilled at short-term trades. So I can look at orders coming in and using this tool, and particularly using something like CME futures, the Bitcoin futures in the CME, the Chicago Mercantile Exchange futures. And with this, I get about 10 or 15 opportunities a day where I can capture 2 to 3, maybe 4 ticks or more, and each tick is worth $75, with about an 80–85% win rate. So once you get good at something like this is one of those short-term trading skills. It takes a little while to get skilled at it, but I would recommend doing it with a simulated account. But this is one of those skills that is using strictly volume and order flow, that you can easily determine when a market is coming in and going to move another 3 or 4 ticks in the next couple of minutes or not, and then ride that little bit of a wave and then make that kind of profit. It's not a lot of profit, but you can do it consistently. And it's not unusual. I mean, when I'm doing this and I'm on it and I have the time, I can eke out, you know, $200, $500, $1,500 in a day. It's purely for scalping, but it's scalping order flow. And the type of scalping that most people are used to using price action is completely ineffectual. It's probably the stupidest possible idea I've ever seen in my life, because nobody in their right mind in the world can make a living off of scalping from price action. It's just not possible. This is roughly the same kind of methodology that proprietary trading firms use, where they don't even use a price action chart. They don't even use a chart. They only use the time and sales window and the order book. Can you use long-term tensor data for long-term trades? You can. Yeah, you can. You can use volume there and get some insight on that as well. I mean, they do go up to 4-hour charts. And so you can get some pretty good information here. There are also a scripting module in here. Now, I've helped the developer here develop a lot of the ideas in this, by the way. And there's all kinds of scripts that let you detect certain events that happen in the market. It's a developing tool. So it's something cool to, you know, to understand and get involved with. He's developing more, you know, tools on the side of volume profile, like let's see, these fixed charts. You can develop a little profile like this. Eventually, these will be movable and resizable. Right now, they're not, but it's a very, very cool tool. So yeah, so you can use it, but it's not easy to draw horizontal lines, for instance. I don't know if there's a way to do it. I guess you could do the trend line here and do this. But he's going to develop a tool that's actually going to detect the low volume wells and the high volume nodes, and it's going to draw those lines across for you automatically. And then you can click this button and go full screen if you want. See, already he has shows lines at the POC and at the high value nodes, but I don't know that these are really that useful. It would be better in what he's developing now, lines that will come straight out of the high value nodes and low volume wells. So this is really a fantastic tool. It's free. It's still lacking, you know, what TradingView will give you. So from that respect, I think TradingView is still the tool to use. But once this gets to that point where I'm having him push it, I think this will be a great tool. And I think at some point he's got to charge something for it, but he'll probably charge like $5 or something, you know, totally undercut TradingView, and it will be a far superior tool. It'll be a superior tool for what it's designed for, and that's to trade using volume profile and order flow and a volume-oriented analysis. There is no order flow in TradingView. They don't have the same tools. While you can get a time and sales window in TradingView, there's no filter like he has with a trade counter where you can actually measure order flow. And he also has other tools that come into play here too that I haven't mentioned yet, but there's a wide range of tools that we're both working on to try. And he's also making another tool that's going to be very cool that will allow you to take various bits of criteria across all the tools and then consolidate it into like a dashboard. And that will give you that long-term view that you're asking for, whether you're bullish or bearish, kind of a sentiment tool. So that's going to be on the radar. And these aren't limit orders. Well, in the order book, those are limit orders. In the in the time and sales, or what he calls the trades counter, no, those are actual orders. Well, it's pretty simple. In the trade counter, what I'm looking for, the way I've set it up, I'm just looking for either a whole bunch of reddish coming in and going down, or a whole bunch of green. Like right now, we have a whole bunch of green, but in the 4-hour time frame, that's hard to see. I'd rather do a 2-minute view. So here I can look at the chart. I can see that we've got a lot of buys coming into the market. Starting right here, I'm not saying that this is where you would take a long, but I'm saying that right now, because there's really not a lot of volume in here right now at all. So I wouldn't trade this right now in today's market, in the market as it stands at this moment on a Saturday. Now we have some selling coming into the market. Now, after a while, you start seeing patterns develop here, and then you see these reds get pegged, and that's usually what I do. I look for shorts. And over time, as we start developing these tools and start developing the scripting, some of these things are going to be really easy to pick off, and it's going to be a fantastic scalping tool. So that is a tool that I think you should keep your eye on. It's being developed continuously. I'm in constant contact with the developer. How do you turn on the volume profile? Well, the volume profile is here already. It's these gray lines over here on the right. It needs probably a little bit of work, I think. It's pretty good, though. Down below, there's a V profile button down here. You can turn it off and on. And it's really real time. Look at this, how it calculates. It's fantastic. Oh, really? Your dog's barking at mine? Yeah. One of my dogs is at a dog show right now. And he must think that someone's at the door. Maybe there's a delivery or something. As a matter of fact, give me 1 second. Who is that? Oh, he's back already. I'm sorry. No, that was the breeder bringing the dog back home. He only came third in his class, but we have tomorrow. We'll see what he does tomorrow. Yeah, there are some good short tutorials on Tensor. I'm going to be helping him out with that as well over time. Working more on just the functionality right now. Okay. That is the conclusion of this class. Along with this, as I said, you get an hour coaching, so you can contact me and we can work out a time for that. And we can talk about anything that you would like. What I would recommend is that you go to my website and here, hold on a second. So this is my website, Trader of Futures. And here is sort of an anatomy of a coaching session and how I usually conduct them. And if you like that and you think that it's something that you want to continue with, I have a number of coaching clients. I have people that are professional traders, people that want to be professional traders, people that are just retail traders looking to up their game or come up with a specific strategy or kind of put everything into perspective. I have institutional clients where I'm helping them manage their large portfolio, et cetera. So I have a number of different clients. So that's completely up to you. This is a free trading session or coaching session. And I do have, let's see. See if this brings you over there. So this goes into a little bit more detail about how it works. So this is a $300 value, by the way, at one coaching session. I also have I'm not sure why there's two of them here. There are also different programs that I have. One that is a longer term, medium term, and longer terms group. Oh yeah, and then a four block session, a 12 block, and then a 26 block session. But these may be things that you're interested in doing to up your game. And then I talk a little bit more detail about how we go through this whole thing. All right. Anybody have any questions? I'm glad you enjoyed it. Now remember, you can you'll follow me on Discord if you're not already there. Let me give you the link. Let's see, what's the best way for me to get a link?
Main rally this week.
Hey,
friends, Ernie here from the trip. Hey, friends, Ernie.
Here's the link. If you're not already part of the Discord group, here's an invitation. Also, every day, every weekday, at least for the time being, the link isn't here right now, but I'll get it for you later. There will be a Twitch channel where I broadcast every day at noon, but I don't have that available right now, so we won't talk about it. The pattern site, I think, is something that you want to with Thomas Bukowski. And then, of course, you can call me. Don't call me this afternoon. I have another class that I'm doing. It's my mobile number. All right. Anything that I didn't answer for you, or you would like more clarification on? That now's the time to ask. Otherwise, I'm going to shut it down. All right, guys. Thank you very much for attending. Look forward to working with you individually. All right, now I got to figure out how to turn this off. Let's see. Hold on. Stop the share. Thank you. We'll see you next time.